Today, the stock market is, well, it's breaking historical records, but at the very same time, millions of people are literally fighting over the price of diapers at Target.
Right, it's a completely fractured reality.
Exactly. I mean, we are looking at a financial landscape that's flashing bright red and brilliant green at the exact same time. It completely defies the conventional wisdom that, rising tide lifts all boats. Instead, we're witnessing this profound fracture in the economy.
It is the absolute definition of diagnostic muddy waters. The classic indicators we rely on to gauge economic health are, well, they're completely contradicting each other right now.
Welcome to Tech Money Madness, your daily deep dive into the U.S. stock market. Today is May 13th, 2026, and we are digging into a comprehensive daily market briefing that honestly feels like it was written about three entirely different planets simultaneously.
Yeah, that's a good way to put it.
The mission of this deep dive is to decode these deeply mixed signals. We're exploring this weird scenario where the Nasdaq and the S&P 500 have just reached record closing highs, but at the very same moment, Dow Jones futures are tumbling and the everyday consumer is signaling severe distress.
Severe distress, yeah.
Okay, let's unpack this, because I promise you this isn't just going to be some dry reading of numbers. We are going to map out the very real domino effect these metrics have on your everyday life, starting with the widest divide of all.
Yeah, and that split in the market, it isn't a random occurrence. It's a structural separation driven entirely by technology.
Right.
The record highs you mentioned are being propelled almost exclusively by a historic surge in the AI and semiconductor sectors.
Yeah.
I mean, to give you some context from our briefing, the semiconductor sector alone has surged over 60% just since March.
Wow. Over 60%.
Yeah, that is an explosive timeline for an entire sector of that size.
60% in roughly 2 months is just staggering. And when you look at the individual players like Alphabet, they've had a 160% rally over the past year.
Which is incredible.
It is. Our source notes this proves the sheer value of owning a large chunk of what they call the AI stack. But hold on. I hear AI stack thrown around constantly. Is that just a fancy buzzword for, buying a bunch of cloud servers, or is there an actual architecture here?
No, it is a very literal architecture. Think of the AI stack like a skyscraper.
Okay.
At the foundational level, you have the raw silicon, right? The chips. Above that, you have the physical data centers housing those chips. Then the computing platforms, the cloud infrastructure to manage the data.
Got it.
Then you have the proprietary data sets used to train the models, and finally, the consumer-facing applications at the penthouse level. So when a company like Alphabet rallies like that, the market is rewarding them because they don't just rent a floor in the building. They own the concrete, the elevator, the plumbing, and the penthouse.
And the market movers today reflect that momentum perfectly. The most active stocks across the board are Nvidia, Apple, and Tesla. We're seeing companies like Nextpower, Maxite, and Corning as top gainers.
Yeah, they're all heavily tied into those advanced tech ecosystems.
Exactly. Meanwhile, legacy or niche players like Red Cat Holdings really stumbled. But I want to move past that old cliche of calling this a two-horse race. It feels less like a two-horse race and more like trying to fly a supersonic jet while still tethered to a horse-drawn carriage. I mean, the industrial, traditional, retail, and legacy healthcare sectors in the Dow are just dragging in the mud.
That is a much more accurate visualization, honestly. The Dow represents an older economic operating system. But the tech sector is accelerating so fast, it is actively changing the mechanics of global diplomacy, which actually leads us to the biggest geopolitical news of the day.
Right. President Trump is currently visiting China for a high-stakes summit with Xi Jinping. But he didn't just bring State Department officials. He brought a delegation of heavy hitters.
Very heavy hitters.
We're talking Nvidia's Jensen Huang, Tesla's Elon Musk, and Apple's Tim Cook. They are all there. So let me play devil's advocate for a second. Is bringing tech titans to a geopolitical summit just a glorified sales trip, or is it a new form of modern diplomatic soft power?
What's fascinating here is that the line between a sales trip and statecraft is completely dissolved. In the 20th century, a president might bring the heads of Ford or Boeing to signal industrial might.
Sure, flexing the manufacturing muscles.
Exactly. But today, AI, semiconductors, and global data networks are the absolute core of national security. By bringing Huang, Musk, and Cook, the administration is signaling profound diplomatic and business positioning in a key global market.
So we're literally negotiating diplomacy and teraflops and supply chains now.
Precisely. And just for context, a teraflop is a trillion floating point operations per second.
A trillion?
Yeah. It is the raw measurement of how fast an AI brain can think. Nvidia's chips provide those teraflops. Apple's supply chain is deeply entwined with China, and Tesla has immense manufacturing and market share there. Their inclusion indicates that this summit isn't about, tariffs on steel. It's about establishing the rules of engagement for the next decade of technological dominance.
But while the US and China are sitting in Beijing plotting out the digital future, the global markets are simultaneously being violently disrupted by the physical present. I mean, we still need raw energy to power those teraflops.
Yes, moving from geopolitical diplomacy directly into geopolitical conflict. Because while tech is soaring, the physical foundation of the global economy, which is energy, is under severe stress.
And that takes us to the Middle East. We are looking at Saudi Aramco reporting a 26% jump in their first quarter profit. The briefing makes it very clear why. Their key pipeline reached full capacity directly amid the ongoing Iran war.
Yeah.
Can you break down the mechanics of how a regional conflict instantly translates to a 26% profit spike for a specific oil company?
It really comes down to risk premiums. When conflict erupts in an energy-dense region, the threat of disrupted shipping lanes or destroyed infrastructure causes panic.
Makes sense.
So buyers scramble to secure reliable oil contracts. Saudi Aramco, with its vast and highly protected infrastructure, becomes the primary beneficiary. Their pipelines run at maximum capacity to make up for actual shortfalls, or even just perceived threats to the global supply.
Which leads to a completely wild data point from our briefing. China's inflation beat estimates in April, and the briefing explicitly links this to the Iran war.
Wait, so a conflict in the Middle East is directly driving up producer prices and inflation, all the way in China.
If we connect this to the bigger picture, you can see the raw, unavoidable mechanics of the global supply chain. It functions like a massive transmission engine. China is the manufacturing hub of the world.
Right.
To manufacture goods, you need immense amounts of energy.
You need to keep the lights on in the assembly plants, and you need diesel for the cargo ships.
Exactly. So when the Iran war causes a shock to global energy markets, oil prices spike. That means the cost for a factory in Shenzhen to produce a plastic toy or a television or a car part, well, it goes up. Their baseline producer prices rise.
And they don't just eat that cost.
No, China doesn't just absorb that cost out of the goodness of their hearts.
They pass it on to the buyer.
They have to. They pass it on to the buyers in Europe, in South America, and in the United States. So an energy shock in the Middle East creates an inflation shock in China, which then physically exports that inflation across the ocean to the rest of the world.
And that exported global inflation trickles right down to the United States Federal Reserve's playbook. And ultimately, straight into your wallet. The Fed is looking at this imported inflation and making some very tough calls.
Very tough calls.
The briefing notes that the Fed is transitioning to Kevin Warsh, and it explicitly states this signals a definitive pause in rate cuts. I need some background here. Who is Kevin Warsh, and why does his arrival instantly freeze rate cuts?
So Kevin Warsh is a former Federal Reserve governor, and he's widely known on Wall Street as a staunch inflation hawk. In central banking, a hawk is someone who prioritizes keeping inflation low, even if it means sacrificing short-term economic growth or employment.
As opposed to a dove who prefers lower interest rates to stimulate job creation. Correct. So, by transitioning to Warsh, the institution is broadcasting its philosophy. They're signaling that they believe inflation is still a severe threat, likely due to those very supply chain shocks we just discussed, and they will not lower interest rates to stimulate the economy anytime soon.
The market is definitely reading the room on that. Right now, the 10-year Treasury yield is standing at 4.46%. But more importantly, the markets are currently pricing in a 97.6% likelihood that Fed rates remain entirely unchanged in June.
Which is huge.
Yeah, 97.6% is about as close to a sure thing as you ever get in financial markets. So rate cuts are officially off the table. Let's talk about what that means for the person listening to this right now, because the consumer impact is where this gets completely tangled. Our source notes that the U.S. retail sector added nearly 22,000 jobs in April. That is a fifth of the total job growth in the country. But at the exact same time, consumers are flashing major warning signs. Target is aggressively trying to win back busy families from Walmart, starting a price war in the baby aisle. Meanwhile, Nintendo stock just plunged 8% after announcing a price hike for their upcoming Switch 2 console and releasing a very weak sales forecast.
This perfectly encapsulates the severe tension of the current economy.
But I'm struggling to make the math work here. Retailers are hiring like crazy, but the consumer is tapped out. They're ditching the new Nintendo Switch for cheaper diapers at Walmart. So why did the retail sector just add 22,000 jobs? That makes zero sense. Are they hiring people just to watch empty aisles?
It sounds counterintuitive, I know, but it's actually the direct mechanism of prolonged high interest rates at work.
Mm.
When the Fed keeps rates high, credit card debt gets more expensive, auto loans balloon, and mortgages become unreachable.
So everyone's broke.
Pretty much. The average consumer's monthly overhead expands dramatically. So they undergo a forced shift in their spending habits. They completely cut discretionary spending.
Like a new gaming console.
Yes. A new console, especially with a price hike, moves from a must-have to a maybe next year. That's why Nintendo's stock took a hit. The market knows the consumer doesn't have the elastic income for it. But you still have to buy groceries. You still have to buy essentials. And the logistics of selling essentials are incredibly labor-intensive.
Okay. So selling one high-margin Nintendo Switch takes one transaction, but moving thousands of low-margin diapers and groceries requires constant restocking, warehousing, and checkout staff.
That is the paradox. Retailers have to hire more staff to manage the high turnover of essential goods, even as their overall profit margins shrink. And because consumers are feeling the pinch, they become hypersensitive to the price of those essentials.
They start shopping around for the best deal.
Exactly. Target realizes they are losing market share to Walmart because Walmart is traditionally perceived as the absolute baseline for low prices. So Target has to fight back, starting with the stickiest demographic, which is young families.
Right.
If you can win a family in the baby aisle with cheap formula, you might keep them for the rest of their grocery run.
They're using baby products as a loss leader to capture a stressed demographic. It really paints a picture of a consumer base that is just squeezing every single penny. But here is the ultimate twist of today's briefing.
Okay.
While the everyday consumer is penny pinching in the baby aisle, institutional capital is playing an entirely different game. They are looking way past the current economic pain and pouring billions into the digital plumbing of the future.
The macro environment is undeniably tough for the individual, yes. But institutional capital operates on a 10-year horizon. They are moving aggressively into next-generation tech.
Let's look at the crypto space first, because this data point is wild. According to the briefing, Circle just raised $222 million in an ARK token presale that is valued at $3 billion. But what stops me in my tracks isn't the number, it's who is writing the checks.
The investors.
Right. We are talking about legacy giants like BlackRock and Apollo. Hold on. 5 years ago, Larry Fink and Wall Street were calling crypto an index of money laundering. Now they are pouring hundreds of millions into an ARK token presale. What changed? And what even is an ARK token?
What changed is the realization that the underlying technology is wildly more efficient than traditional banking. An ARK token, in this context, is part of a blockchain ecosystem designed to handle tokenized real-world assets and stablecoins.
Okay.
Think of it as a new set of digital pipes. Traditional cross-border transactions using the SWIFT banking system take days to settle and involve multiple middlemen taking a cut.
That a stablecoin transaction settles in seconds.
In seconds, for fractions of a penny. When you see BlackRock and Apollo stepping in to back Circle, which operates one of the largest stablecoins in the world, it tells you that Wall Street no longer views crypto as a speculative casino.
They view it as infrastructure.
Yes, they view it as the inevitable future plumbing of the global financial system. They aren't buying digital art. They are funding the actual infrastructure that will eventually process your mortgage payments and stock trades.
Speaking of building out the future infrastructure, let's talk about the artificial intelligence sector, specifically the regulatory split happening right now. Our source notes that OpenAI is giving the European Union access to its new cyber model, but Anthropic is holding out.
Yeah, that's a big deal.
They are keeping their new model, called Mythos, away from the EU. Why the radically different strategies from two of the biggest AI players on Earth?
It comes down to geopolitical strategy and the weaponization of open versus closed source data. The EU has established some of the most stringent AI regulations in the world, requiring deep transparency, safety audits, and data compliance.
Which is a massive headache for tech companies.
It is. But OpenAI is making the calculation that the massive cost of compliance is worth the market access. They want their models deeply integrated into European enterprise and government systems.
And Anthropic. Why leave an entire continent of revenue on the table?
Anthropic is seemingly taking the opposite bet. By keeping Mythos locked down, they might view the EU's regulatory burden as a Trojan horse for intellectual property theft, Or they believe that complying would force them to reveal proprietary training methods.
That makes sense.
They're keeping their model closed source, perhaps prioritizing secure, high-value contracts in the U.S. and aligned markets over broad, heavily regulated international adoption.
Here's where it gets really interesting. Because all of this AI, whether it's OpenAI in Europe or Anthropic holding out in the US, it requires unfathomable amounts of data and computing power. Our briefing notes explosive growth in the data center sector. But there is a prediction in here that honestly feels like science fiction.
The tiny data centers.
Yes, they are predicting that tiny data centers may soon be installed directly inside people's homes.
This raises an important question about infrastructure, right? The concept is known as edge computing, and we are seeing it pushed to its absolute physical limits.
It reminds me so much of computing history. We had massive, room-sized mainframe computers in the 1970s that only universities had, and then the personal desktop PC put that power in every home office. Are we about to do that again, but with server farms?
It is a fantastic analogy, and this shift is being driven entirely by physics, specifically latency and heat. The relentless march of AI requires processing power that is generating two monumental problems.
Okay, what are they?
Well, centralized data centers are getting so huge they are taxing local power grids and requiring industrial cooling solutions that consume millions of gallons of water.
Right, the heat issue is massive. And what about the latency issue?
If you want your AI to have real-time, instantaneous reactions in your home, say, for advanced robotics, smart grid management, or autonomous vehicles, sending that data hundreds of miles to a centralized server in Virginia and waiting for it to come back just takes too long.
Even if it's just milliseconds, it's too slow for a robot trying to catch a falling glass.
Exactly. So the proposed engineering solution is distribution. If you put a tiny data center, a microserver essentially, in millions of residential homes, you solve both problems.
It's wild.
You distribute the immense heat output, you distribute the power draw across the entire residential grid rather than concentrated industrial zones, and you achieve absolute zero latency processing right where the end user is.
That is mind-bending. And it brings us full circle on today's briefing. Let's just recap the journey we've been on. We started by looking at a market completely fractured, driven upward by the sheer momentum of the AI stack, while traditional stocks struggled. We traveled to a high-stakes geopolitical summit in China, where tech CEOs are acting as the new diplomats. We traced the physical realities of the Iran war, driving up Saudi oil profits, which then drove up manufacturing costs in China, which then exported inflation right back to our shores.
It's a textbook example of the butterfly effect in modern global economics.
We saw how that imported inflation forced the Fed to embrace a hawk like Kevin Warsh, pausing rate cuts and leaving everyday consumers so financially squeezed they're skipping the new Nintendo to fight over diaper prices at Target. And finally, we looked at how institutional capital is ignoring all that short-term pain to fund the future.
The long game.
Exactly. From BlackRock buying into the crypto plumbing of Wall Street to the wild idea of mini data centers humming in our living rooms. Whether you're actively buying tech stocks or you're just trying to buy groceries, these connected macro forces are shaping your daily reality.
They absolutely are. It is all part of the same complex, interwoven machine.
So what does this all mean? I want to leave you with the final thought to mull over, building on that edge computing prediction. If the relentless march of artificial intelligence requires so much processing power that we eventually end up with tiny data centers running physically inside our own homes, how will that completely redefine our physical relationship with the internet?
It's a huge shift.
What happens to our personal privacy when the cloud is no longer in a remote desert, but literally humming in our hallway closet? And what does it mean for our fragile local energy grids when every single house is running a physical piece of the global AI brain?
Those are the questions of the decade.
The financial dashboard might be throwing contradictory signals, and the economic waters might be murky, but the infrastructure of tomorrow is being built right now, brick by digital brick.
It certainly is, and watching it unfold is truly remarkable.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.